please, we're not here for that today. My favorite colors are purple and pink. But Sasikolap. Guys, I'm reading an article here about a new tax rule for retirees in South Africa. Guys, shukuthi kahle kahle we're not supposed to breathe. We're basically not supposed to breathe. The government, the treasury, SARS is just on our necks. And it's worse for us who are still yet to retire. So if you are retired in South Africa or planning to retire soon, SARS and National Treasury have just changed the rules of the game. I'm just scanning through this article here, but a brand new draft bill has targeted a specific loophole that many retirees use to cash out their policies tax free. If you don't know about this change, you could face an unexpected tax bill or get blocked from accessing your cash entirely. Can you imagine, guys? How crazy is that? What kind of world are we living in? What kind of country are we living in at this time, guys? In Cyril's economy, you are, guys. Mm-mm. So basically, in this live, I was gonna say video, but in this live, we are breaking down the critical new updates from the 2026 taxation laws amendment bill. The new tax-free threshold for seniors, your guys, and exactly what you need to change in your retirement strategy today or from now going forward. So if you want to read the article, I got this article from Daily Investor. So you can just Google, find the article, and you can read it yourself. I'm not going to read it. I read it already. It's pretty long. It's very long. So, yeah, yeah, man, I just have my notes here, and let's just start with the biggest change in the new 2026 draft bill, right? So it targets living annuities. Up until now, if you had multiple small living annuities, you could treat them as completely separate policies. If a policy fell under 150,000 rand threshold, you were allowed to cash it out entirely as a lump sum. So, but now SARS noticed that people um, are breaking their retirement money into several small policies to bypass the rules. So basically, under the new proposal, if you hold multiple small living annuities with the same insurer or fund, they will now be aggregated, meaning lumped together. Meaning lumped together. Oh my God, please hold for me, guys. My son has something to say. How do I pause this? Okay, anyway. Yeah, guys, if the combined total basically of those policies goes over 150K, you lose the right to cash them out. You will be forced to keep drawing a monthly income instead. So, whew. But there are good news I can say for lump sums and RA deductions, retirement annuity deductions. It's not all bad news, guys, though. But I mean, the government has actually increased some major thresholds to give you more breathing room. First, the de minimis threshold to cash out on your entire retirement fund at retirement rather than being forced to buy an annuity has been bumped up significantly. So I went so it went from 247,500 all the way up to 360,000 rand. Yeah. And second, if you are still working part time, you know, or contributing to a retirement annuity, the maximum amount you can deduct from your taxes every year has jumped from 350,000 Rand to 430,000 Rand, capped at a 27.5% of your taxable income. So basically, this is a major or massive win for high income earners trying to lower their current tax bill, right? Oh, yeah. But now it goes to the foreign pension shock, because now if you receive a pension from overseas, um, pay close attention to this. Effective from the 1st of March 2026, the long standing tax exemption on foreign pension retirement funds for South African tax residents have been officially reappealed. So, South Africa basically operates on a residence based tax system. This means your global retirement income is now fully exposed to SARS. Mm, they are auditing lifestyles, remember? They're auditing lifestyles. So, basically, if you rely on overseas pension, you need to review your structures immediately, as soon as possible, ASAP, ASAP. So yeah, to adjust for inflation and bracket creep, I guess SARS has also updated the annual tax-free income threshold for seniors. So if your total income for the tax year is below these amounts, you pay zero income tax, basically. So if you are under 65, you don't pay tax on the first 95,750 Rand. If you are between 65 and 74, that tax free threshold jumps up to 148,000 Rand, 217. If you are 75 and older, you can earn up to 165,689 Rands, completely tax free, right? Completely tax free. So, but also, if you are 65 or older, you shouldn't forget your domestic interest exemption. You shouldn't forget that you can earn up to 34,500 Rand in bank interest every year without paying a cent on it, basically. So I'm just trying to check something here on my phone. Yeah, yeah. So, yeah, do what you may with this information, but I think I would first check with my providers. If I have a small living annuity sitting in the same insurer or sitting with the same insurer, speaking to a financial advisor about how this aggregation rule affects your liquidity plan. Secondly, make sure your accountant, if you have one, is using Section 10C. If you historically overcontributed to your retirement funds, Section 10C allows you to use those excess contributions to make your current living annuity drawdowns tax free. So, thirdly, leverage the new tax savings account limits, which historically overcontributed to your retirement funds. Which have risen to 46,000 Rand a year. It is one of the best ways to build tax free growth in retirement. So, yeah, if you found this video helpful, hit the like button, subscribe to the channel for more South African financial updates, and drop a comment in this live or after this live if you have any questions about these new rules, and I will try to respond to those comments or